Welcome back. We are now starting with Unit 2.8 and this section we're going to discuss in income tax. This is a very short session, but it's not meaning that income tax is not important. We will see as you progress in your career in life assurance that income tax plays a very, very definite role and a very important role in your advice that you give to clients. Right, let's have a look at the 5-fund approach. Because one day, when I was running a training session, I said that the proceeds from a policy is tax-free, and somebody really took me on about that. Yes, the payout amount that the person receives in his hand is an after-tax amount, which to the client would feel like a tax-free amount. But in effect, the policy is taxed inside the policy fund. And there's 5 funds that they are taxing. Tax is always payable on income or earnings except for low income earners. The proceeds of insurance policies are tax-free if they meet certain outcomes. Not really tax-free, as I said, because it was already taxed, but it feels to the client as if it's tax-free. Tax is therefore payable by insurers in another way, namely in terms of a 5-fund approach as outlined in the Income Tax Act. Insurance companies must keep policyholders' money in 5 separate funds according to the policy type. The underlying investment earnings and capital gains are subject to income tax and capital gains tax. Taxes are deducted from investment earnings before they are allocated to the policyholders. Right, let's have a look at the 5 funds. Number 1 is an untaxed policyholder fund, which is managed. Policies are owned by the fund, whether it's a pension fund, a provident fund, a retirement annuity, or a benefit fund, or annuities in payment. And policies is issued to non-tax paying institutions, for example, local authorities, charities, churches, etc., as set out in Section 10 of the Income Tax Act, which has got a whole list of exemptions that are granted to these parties that falls in the untaxed policyholder fund. A policy owned by a trust consisting only of such person also funds or falls into the untaxed policyholder fund. Then we get a company policyholder fund, or CPF, which manages the policies owned by a company. A non-UPF or non-IPF policy owned by a trust also falls into the CPF, or the company policyholder fund. Then you get the IPF, or the individual policyholder fund, which manages those policies that are owned by individual policyholders, which will be most of your clients. For example, natural persons. A policy owned by a trust consisting only of persons other than the company also falls into the individual policyholder fund, or IPF. Then you get a corporate fund, or CF, in which it manages all the assets and liabilities owned by the insurer itself. And then you get the risk policy fund. In this fund must be placed assets having a market value equal to the value of liabilities determined in relation to any risk policy. Now let's have a look at the various rates at which these funds are taxed. On the next slide, you'll see the rates for the 2022-2023 tax year. The individual policyholder fund, or IPF, is taxed at a 30% rate. The corporate policyholder fund, guess what, is taxed at 28%, which is the corporate rate, and which eventually will reduce to 27%. The untaxed fund, or retirement capital, is in the untaxed fund, and obviously it's a 0% rate. And then the untaxed funds, which is in the tax exempt fund, which is tax exempt, obviously 0%. And then your risk policy fund at 28%, and then your corporate fund insurer's reserves, which is then also taxed at 28%. Right, if you do transfers between funds within 4 months after the end of the year of assessment, the policies in each of the funds must be valued again in the market value of the assets in a fund exceeds the value of the liabilities in its, then this profit must be transferred to the corporate fund. Should the market value of the assets be less than the value of the liabilities, then this loss must be made good by way of a transfer from the corporate fund. These transfers are deemed to occur on the last day of the relevant year of assessment. Such transfers are not part of the income or the expenses of the policyholder fund to or from which it was made. So this concludes our very short session on income tax, but as I said in the beginning, income tax is much more complex than this little session we have now discussed, and you will have to get more tax training as you go along in your career. Thank you for attending this session.